So these people should not do
These people should not do a search.
Yeah, agreed. Welcome to Found and Funded, the Entrepreneurship Through Acquisition podcast for searchers by search experts, where we explore the route to business ownership without having that $1 million idea. I'm your host, Carl Lundberg, CEO at Gerald Edelman and founder of the ETA Awards. Now let's get into it. Who shouldn't do it?
Who shouldn't do it?
Oh my God. Okay.
That's right.
That's basically saying. Oh,
It's lunchtime.
yeah. It's true, we are at that time. In this episode, I'm joined by Will Abell, one of my partners at Gerald Edelman and head of transaction services. Will, you've got a huge amount of experience working with search funds. It'd be really good to hear a bit about your background initially, and you know how your career has led you to working with searchers.
Yeah, absolutely. So my career started back in audit for PwC, and I was based in the South Wales office in Cardiff. And shortly after qualifying, I think this was sort of summer 2017, I moved to GE, and that was when my time in deal started, and I haven't really looked back ever since. So in the last 7 years, I've been doing sort of predominantly M&A, buy-side M&A transactions, and particularly in the last sort of 3 to 4 years, a lot of that, the vast majority, has been with searchers.
I think definitely the right person to have this first chat with, and obviously the idea of today's episode is to give a bit of background for the viewers and the listeners about search funds generally, and give a bit of a guide. So I suppose let's get straight into discussing some search funds, which I know both of us love to do. So to set the scene, we'll start by going back in time and looking at the evolution of search over the years. The original search funds, I think, were originally conceived at Stanford University back in 1984, a long time before you were born, not so long before I was born. Perhaps you could tell us a little bit about the kind of the original Stanford model.
Yeah, absolutely. I mean, the model, as you say, has existed from then, and while there's been developments, as you'd expect, the model now hasn't really deviated that much from sort of the original concepts back in the mid 80s, and really it's because it works for or can work for everyone involved. If you look at the entrepreneur's perspective, it gives them a route to business ownership that they might not be able to obtain through any other method, and particularly at the age profile you see of searchers. And then if you look at it from the investor's perspective, and the returns have been historically very good.
Yeah.
And then also if you look at it interestingly from the seller's perspective, actually, whilst search transactions might not unlock the sort of high multiples you might get in some other transactions, it can enable a seller to sell to someone who really protects the legacy and builds on what they were doing. So it can be quite an attractive exit strategy for sellers as well. So really, it can work for all parties involved, and that's why I think the model really continues to thrive.
That's it. I think there's a massive succession piece in search, and I think we can get into that a bit more later. So that's the original kind of Stanford model. That's what we now often refer to as traditional search. Over the years, I think the model has to some extent evolved. I know in the US and also in the UK and in Europe, but particularly in the UK, from my experience, there's a lot of what we call self-funded searches, and there's also another model, that's broadly known as kind of sponsored. There are accelerators as well, but yeah, I think the self-funded model is effectively the same as traditional, but without the search capital at the beginning, and sponsored, will usually have a family office or a cornerstone investor backing them. As well as that, we've got the accelerator type, incubator type models as well. I think it would be good to start with, let's take a traditional search fund or a Stanford model search fund and talk through the process start to finish. That might be quite useful. Yeah,
absolutely. So in the first stage, for all traditional searchers, will be raising their initial search capital. So I mean, this is a process that probably takes somewhere between sort of 2 and 6 months. So during that period, they'll be preparing their PPM, reaching out to potential investors and trying to secure that initial investment. And that investment will cover, I guess, the search period, which is generally a period of, I guess, up to 2 years, potentially a little bit longer in some circumstances. Mm-hmm. So that will be stage one. Stage two will be the actual search itself. So that will last potentially up to 2 years. And that's when the search will be full-time dedicated to finding the right acquisition target. Mm-hmm. Once a target has been found, and the next stage will be actually executing that deal. And at that point as well, the searcher will go back to usually the same investors to raise the acquisition finance at the same time. There'll be the due diligence process and ultimately getting the deal done.
Yep.
And then the next stage will be actually operating that business. And that's, I guess, the fun bit, which will last anywhere some sort of 6 to 10 years.
I suppose each bit's the fun bit when you're there, but I think certainly the hardest bit is probably the operating post. I think people perhaps don't always appreciate that. I think it'd be good to get into a bit more detail around the terms of the investors of that search capital. I think we can talk a bit more about investment in search a bit later, but for now, just to come back to the point you said where you find an acquisition, so you raise your search capital, you deploy it wisely, you identify a target, you get to a deal, and now you need to fund that deal. We know that often usually these things are leveraged, so there's at least an element of debt going in. Hopefully some form of vendor financing as well, which perhaps you could talk about. But there's generally some equity raised. The terms of a Stanford model search fund would be such that the original search capital investors have a preemption, don't they? So perhaps we can talk through kind of what that capital structure looks like in terms of maybe a bit of vendor financing, bit of debt from a bank or another kind of debt lender, and then the equity piece as well.
Yeah, absolutely. So yeah, you're right. So the original investors, when it comes to the time of raising the acquisition finance, typically they'll roll their initial investment into the transaction. At that point, generally is a premium attached to that, so they usually roll in generally 150% of the original investment.
Yep.
In addition to that, usually the same investors, sometimes there might be a few additional ones, but will also provide new capital at that point in time to actually execute the deal. Usually the investor capital will go in as preference shares, so they get their return, they get their money back and their preferred return first, before you then get into the ords. You mentioned debt, usually a very key part in most search transactions. So typically we see the acquisition price usually funded, about a third of the deal value will be funded by debt, and then quite often roughly another third will be deferred and paid over time.
Yeah, great. I think that the capital makeup definitely varies by jurisdiction, and I think the risk appetite of the lenders, and obviously in the US we know that there are some government schemes that help to fund things like this. Just want to pick up on a point that I suppose it makes it very clear that you and I talk about search funds very often and have various phrases that we use. You said get into the ords. I think I know exactly what you mean, but it might be worth just explaining what you mean by that, and obviously who you're talking about, who has the ords.
Yeah, so because the investors, their capital goes in as preference shares, essentially the holders of the ords, which will include the searcher themselves as well as the investors, they won't ever be paid out on their ords until the investor's return has been satisfied on the preference shares. So usually there'd be a coupon attached to those preference shares, probably somewhere in the region of 8 to 12%, sometimes lower in some cases, and that will usually roll. So essentially that return will have to be paid out first before we then get into what we say get into the ords. And then in terms of sorry, Carl.
I was just going to say being the ordinary share capital.
Yes, correct. And then in terms of that ordinary share capital, under the Stanford model, there's a pretty well-defined sort of way that the searcher themselves will obtain their ordinary shares. So usually they'll invest in 3 tranches, and usually it's a total of sort of 30 to 35% of the ords will be retained by the searcher in 3 tranches. The first tranche usually sort of vesting upon deal completion, the second tranche over a period of time, and the third tranche if a target IRR is hit or exceeded.
Great. Yeah, I think we've seen some variability in that over the last few years, and it does depend on whether you've got a solo searcher, so an individual searcher in with a traditional search fund, or a partnered search. I think we've seen as well down from kind of 25% right up to kind of 35%, but as you say, it doesn't really deviate outside of that, and there's always an element of return based on performance.
Yep.
There's usually a bit based on tenure, and there's usually a bit based on doing the deal. So we've talked about a traditional search fund and the process there. With the self-funded searcher, I suppose the process is the same, bar raising the search capital. They commit and speculate their own time and resources in the search process. But I suppose when we get to the acquisition, they're in a similar place, except they don't have an incumbent group of investors to call on. So how does that differ?
Yeah, like you say, the process is essentially exactly the same, with the exception that there's no search capital raise, and the self-funded searcher is funding that bit themselves. What that does give you, or give a self-funded searcher, is at the point they identify a target, it gives them a little bit more flexibility in terms of the terms they might potentially be able to agree, because that's the first point that they're actually approaching investors, and at that point they've already got an identified deal. So it's a little bit of a different proposition to a traditional search fund, where the investors are essentially backing the individual at that point, whereas that's still happening and for a self-funded deal, but they can look at the company at the same time, which obviously a traditional search fund wouldn't have that at the outset.
Yeah. And I think, there's two sides to this. The traditional investor, or an investor in a traditional Stanford model search fund, has spec'd cash in the search capital. About a third of search funds actually don't ever acquire anything. So, there are some losses realised there. And probably about a third, the investors in the search capital choose not to follow on and put more money into the deal. So really, they only follow on to about a third. So but what they get in return for that is that, one, they get the step up, the 150% rolled in, but they also get the optionality. So they get the preemption. They get first right of refusal, and terms for the ordinary equity that the searcher will hold or receive over time based on the performance conditions and so on is pre-agreed at the time of the search capital. So they know they can invest. They've got a preemption, they've got an option, a right to invest in the transaction at those pre-agreed terms. As you say, in a self-funded deal, no one's committed that. There are no rights or obligations to anyone. So
I think because of that, we see a lot more variation in the terms that self-funded searchers do agree, whereas under the sort of Stanford model, traditional searchers, it's a pretty set amount of awards that a searcher will be able to retain, whereas that percentage does vary quite significantly in self-funded deals, and really it's dependent a lot on the quality of the company and the opportunity that's been identified and found. So we've seen self-funded searchers retain as high as 70% before, which I think was an exceptional case, but quite a 50% is not uncommon at all, whereas that's obviously much higher than we tend to see in traditional search deals.
That's right. Yeah. So there's some reward for going alone, but I think there's pros and cons to both sides, not just economic. If you look at the traditional model, the idea of search, particularly when you talk to some of the traditional investors and some of the early adopters of search funds, the concept really was to take fairly fresh MBAs from good business schools. A group of effectively angel investors would rally around and give them the search capital pot, but they would also be there to provide some support and guidance and advice through the process. So I suppose that there's a benefit of a traditional search fund that you gain, and I suppose in lieu of perhaps holding a bit more of the ordinary equity in a self-funded deal. So the market in the US is far more mature than say in the UK, but we've seen a huge amount of growth in the UK and Europe generally. Do you want to tell me a bit about the expansion of search in the UK and what we've seen in terms of mix between self-funded and traditional searchers?
Yeah, absolutely. So, the UK and Europe generally, I think, has been a little bit behind the US and Canada in terms of the growth of search. But in the last few years, as you say, it really has risen, and there's a lot of search funds out there. And I think I'm right in saying there's a record number of active UK search funds at the moment. And certainly since we've been involved, we've really noticed a massive uptick in that. So absolutely, and it's across both sides. It's traditional and it's also self-funded. And yeah, the amount that we see continuing to come through is really good to see.
Yeah, and I think it's pretty there's a good time to actually clarify for the traditionalists out there, the difference between what we call traditional search fund and a self-funded searcher. I think most people, hopefully all people, will agree that both are acquisition entrepreneurs. They're both, and sponsored perhaps, and possibly less so, but also the incubated or the accelerators, searchers as well. But all acquisition entrepreneurs, all doing entrepreneurship through acquisition. A Stanford model search fund is what the traditionalists would call a search fund, and really only that.
I think if you look at the difference between traditional and self-funded search, it really is only that phase one that is different. As soon as you get to phase two and the target's identified and you're doing the deal, and the process from there on till the eventual exit is identical between the two. So it really is only that first phase that is different, where you've already raised search capital and you can deploy it in that way. But from there on, it's the same.
To play devil's advocate there, if you've got a group of, let's say your terms, you've got a self-funded search, and the terms you're offering are a material departure from the Stanford model, right? So you want to retain 50, 60% of the ordinary share capital. You're not going to get, it's highly unlikely you'll have the core group of the traditional search fund investors, the old guard, investing in your self-funded search, right? So they're not going to help you. So now you'll have other investors. Now those other investors perhaps have a lot to add, but it could be dumb money in that purely a financial play for them. They're not interested in getting involved. They're not going to advise. They're not going to open doors. Isn't there a slight difference as well between the two routes? In that you'll have, in a traditional search fund, if you get the right group of investors, some guidance and support from them as well.
Yeah, and I think you're right. And there are certainly different pools of investors in both. I mean, there's some investors who will look solely at traditional search funds for that reason. I mean, the model is there, it's proven and it works, and that's what they know and that's what they want to stick to. So going down a self-funded route might mean that some of those potential investors wouldn't be as open to it, absolutely. But equally, there's a whole host of other potential investors, perhaps people that haven't been involved in search funds as much historically, who would be open to that kind of thing. So there's still certainly the investor pool there. Yeah. It might be different types. And yes, you're right, that might mean that sort of the way the search fund operates after you've done the deal might be a little bit different. You might not have the same level of oversight and perhaps involvement from some of the sort of traditional search fund investors as you might do if you've gone down a traditional route. So yeah, I think there are a few nuances and differences there.
Yeah. Okay. Cool. No, that's great. And I think probably it's horses for courses, right? It may be that a self-funded search is more suited to a mid-career professional who actually doesn't want people giving them too much advice, and actually a fresh MBA probably may feel a bit more daunting to someone like that.
I think that's what we tend to see, actually. Yeah. If you were to generalise, self-funded searchers probably are a little bit more experienced, a little bit older, a little further into their career, and have that little bit more experience behind them. Yeah. And also generally, because of perhaps a little bit more experience and further along in their career, they might have the means to fund that search themselves. A little bit easier than someone who's perhaps a little bit fresher. Yeah, will do as well.
It's probably still paying for an MBA. Now let's get into the target. So, you've raised your search fund, or you're a self-funded searcher, and you've taken the leap and you've left your job, which actually we're seeing some people not doing that at the moment. But let's assume you have, and you're going full time into the search. What are you looking for?
I always say generally you're looking for a fairly boring business, something that's easily understandable. Yeah. So anything that's complex, I would avoid. You want something that ideally has a history of strong cash generation, ideally some growth, some modest sustained growth over a period of time. And ideally, you'd have, I guess, a strong sort of second-tier management team in there that can help you and support you as the new CEO. And then, in an ideal world, some kind of untapped potential or something that you can exploit. So, I guess the ideal search fund investment would be a family-run business where the last couple of years, perhaps it hasn't been pushed or exploited perhaps as much as it could have been. And that would be absolutely perfect for someone to step in for a bit more sort of fresh energy, new ideas, and really explore that untapped growth.
So I think it may be oversimplifying it by saying some low-hanging fruit, but often you say what you're looking for, and they'll say, well, unsexy industries and boring businesses with, the opportunity to increase earnings and increase cash flows. But a common statement we get is terrible website. If they've got a terrible website, if they've got no real marketing function, well, actually, for some of these more enthusiastic, perhaps more ambitious, or just earlier in their career people, they can come in, they may have the skill set to turn on that marketing machine and actually fairly easily dial up the earnings of the business.
No, you're exactly right. And I think in addition to that, really the key thing really is those stable cash flows, and ideally a good, loyal, recurring customer base is really important. And that's what we always look for as part of DD.
Cool. But just out of interest, just to give people a bit of background, what's the kind of biggest issue or the most common issue or a theme that you come across that doesn't necessarily stop the deals, but you would flag to a searcher?
Yeah, so digging through their revenue is always one of the major focuses of DD, and I guess the things that come up there are reliance on one or a small number of customers. That would be an immediate red flag. It just increases the risk of any potential deal by a lot. So that's a very common problem that we see. Also, and it's particularly a problem when you've got brokered deals, the EBITDA just isn't the right number, and suddenly the deal mechanics completely change. Common things people miss out there are including appropriate management remuneration in there.
All the time.
Yeah, that comes up on almost every deal that we see, and there's a few other things that you look for in there. So it's really interrogating that EBITDA number, making sure that it is accurate, because that drives the whole sort of deal mechanics.
Great.
And then I guess thirdly, making sure that profits are actually turning into cash, and there's no sort of leakage anywhere. So I guess the third thing always to look at.
Yeah, cash is king.
Cash is king.
So that's useful, and actually, a really good little snippet of advice there for what to look at before you go too far, right? What we want to do is make sure that the earnings figure, particularly if you're taking a multiple of an earnings figure, is truly sustainable, and you're not buying yourself a job. Great. So you've identified a boring business, positive cash flows, fairly steady earnings, maybe some slight growth in there. You pack up your bags and you move to Hull, and you're going to go and run the business. What's next? What do you do? How does it work?
Well, I mean, the first thing I think the advice searchers normally given is don't do anything too soon. Sort of learn the business. I mean, it's always going to be a bit of a shock, I'm sure, going into a business like that, particularly stepping into the CEO role, particularly if you haven't had that kind of experience before. So just take your time, learn the business, and then and once you've got to grips with things and fully understand it, then start to implement some changes at that point. Yeah.
So you're right in that. Actually, these businesses can generate a decent return, hence the profile of the business, without having to do too much through the art of delevering. Okay, so there's going to be debt put in. It's cash flow positive. Some of that cash is just going to come to reduce the amount of debt. Immediately, you're generating some reasonable returns there. So don't rock the boat at the beginning, I guess. But then I suppose after that, any additional changes you do make are going to really kick up the returns. Yeah. Great. So we've got, we've been through the process. We've raised our search fund. We've identified a target. I suppose we've talked a little bit about the sort of things we want to look for when we're when we're buying a business and the risks that we might identify. Are there any issues that come up regularly in terms of deal mechanics and actually getting from the, you've got your financial due diligence done and you're working on the legal documents, your share purchase agreement, and so on, and you're looking to get towards completion? What are the hurdles that you need to overcome there? What sort of things do people need to look out for?
Yeah, I think the most common one, which comes up very regularly, is issues around normal and target working capital. Particularly, I think this is quite often misunderstood by people that perhaps haven't been through many or any deal processes before. So I guess the earlier you can sort of bridge that topic and bring that up with the sellers and or their advisors, if they are being advised, the better. So all offers pretty much will be made on a cash-free, debt-free basis, subject to being normal working capital in the business. So it's establishing what that normal working capital is, and I'd certainly make sure that that's addressed as early as you can during the DD process.
Yeah, got it. Yeah, it's a challenge we've seen a number of times, explaining what normal working capital is, which isn't an easy thing to explain anyway, to people who perhaps aren't financially minded or are not properly advised on the other side.
The other thing I'd also say is changes in that sustainable EBITDA number can come up during DD. And what is I guess a particularly helpful thing to do is in your letter of intent, make your offer, make it clear how you're valuing the business or what multiple of EBITDA you're sort of valuing it. It gives you that, it makes it an easier discussion, but it's easier to bring that up. Well, if you find something later on and actually earnings are 100 grand lower than you thought and you valued it at 5 times EBITDA, it immediately makes it far easier to have that conversation about reducing the purchase price on that basis.
£500,000 impact, right? So yeah, it's that's really important.
Yeah.
Great advice.
Yeah.
So well, we've talked a bit about the differences between traditional search funds and self-funded searches when it comes to the sort of the characteristics of the individuals. We've mentioned MBAs a few times. I think it's probably worth just clarifying the reason that MBAs tend to do searches, or regularly we see that searchers have MBAs, is that this is obviously came from academia, came out of Stanford University. Quite a few MBA programs nowadays, teach a search fund module. So we do get a lot of MBAs. There are mid-career professionals as well, as we've talked about. Some of the accelerator, incubator type programs almost ask people to apply for jobs, okay, as CEOs. So do you want to be a CEO? Apply for this, and then they go into the program. It's the right thing. It's a brilliant thing. I love search. You love search. I think it's a fantastic thing for the right people. For the wrong people, it's probably a disaster waiting to happen. Who's the wrong person? Who shouldn't do this?
Very good question, and you're right. It's the perfect model for the right people, and I think people need to understand that it's not an easy thing to do. It requires a whole load of dedication. It's a long process. I mean, typically people are operating these businesses for 6+ years, often in many cases over 10 years. I mean, it's a long time period that you're going to be giving to one particular business. So I guess anyone who's looking for, I guess, a short stint in their career, it's not going to work for you. It's someone who is really going to be prepared to dedicate a large proportion of their life to doing this. And also, the sorts of companies that people tend to acquire can be quite a departure from what they're used to. Particularly, we see a lot of searchers who have come from sort of private equity or consulting backgrounds who are used to working in big corporates.
Quite white collar.
Yeah, exactly. And they're acquiring businesses which are kind of the very opposite end of the spectrum. Very much a blue-collar manufacturing company, perhaps in the north of England, being a typical example. And that environment to work in is very different to what they might be used to. So I guess people that are willing to roll up their sleeves and get stuck in is a necessity.
Yeah, and I think that you're right there. It's not just about experience and academic credentials, right? There's a personal element there as well. And we most of the searchers that we know and have talked to are really nice, likable people, and
Yeah,
actually
exactly.
are,
I mean, it's stepping in as CEO in your first week, you could have HR issues to deal with that you've never seen before. You might have to deal with some sort of issues with customers that you might have never had any exposure to before. All these kind of things are going to be very new to a lot of searchers. So I guess an open mind and willingness to tackle anything is certainly needed.
Yeah, good point. And I think it's that actually leads into an interesting point about what's a more important characteristic to have, or amount of experience to have, when you're looking to do a search. So you're thinking about setting up a search fund or doing a self-funded search, and your background's in private equity, or you're thinking about setting up a search fund and your background's in operations in, a large business, or your operations in an SME. Actually there's a lot of different skills that each of those individuals will have. They're probably going to acquire an SME, but actually probably some of the skills that the operator from a large and the PE can do the deals. So what's the better background?
I mean, short answer is all of those skills are valuable. Which the most valuable, personally, I would say, being an operator, having experience in operations, particularly if it's in an SME environment, that is really the most valuable skill you could have as a new searcher. Deal skills, yes, very useful, and they're going to be needed to get a deal done, but that's the bit that it's only a short element of the whole journey, and also you can buy those skills in much easier.
Yeah.
So that bit, whilst useful, not a necessity, and actually any kind of operational experience, particularly in SMEs, I think is incredibly valuable.
Yeah. No, I agree with that. I think that's right. You can buy in the advice up front, but it's far more costly to pay someone to run the business, and it departs from the original model.
Yeah. The only caveat I'd say to that is we do come across searchers who are doing some kind of roll-up or consolidation strategy. Perhaps they're planning a large number of acquisitions, and often in those kind of situations, they're putting in place proper management whilst they focus on the deal side of things. In that situation, I think someone with more deals experience, maybe that they're better suited to that.
Completely agree, and that was going to be my next question. And I suppose, but what we have seen there is we've seen people who are really good at doing deals, identifying targets, driving process. And I think those people will do really well to establish a group, formalize the processes, and build something from constituent parts that were disparate and unconnected originally. But we have sometimes seen them struggle with SME level or SME type detail in terms of operations, lease issues, staff who are on, minimum wage or the living wage, having personal issues, which, you have a responsibility to deal with. And that is such a far cry from the world of private equity or consulting or even big group formation type stuff.
Yeah, it's easy to get bogged down in all that kind of stuff, particularly as the people who are embarking on the sort of roll-up consolidation strategies. Often the targets they're acquiring are smaller businesses than if they bought just one or perhaps two businesses. And actually in those sort of smaller businesses, perhaps there isn't that middle management layer. So actually a lot of those issues are going direct to the senior management, including the searcher themselves. So actually they're probably getting sucked into those kind of problems that they might not have had as much sort of input in if they've acquired a larger target.
So, well, I agree with you in terms of who perhaps shouldn't move into this, and some people are better suited to others, and there's a scale, and there's some people at one end where you think absolutely this person is like the ideal candidate for doing search, and then you got the other end where you think please don't do it for everyone's sake. But I think that there are people still out there now, and we get approached. It's very easy to spot these people who are out there saying, I'm going to consolidate this market. 17, 18 years old, maybe still a student. They've got a board of all these people who have probably never heard of them, and they say they're going to buy a company. They're going to do it 100% vendor financing. No money down. What are your views on them?
If I'm being blunt, they're time wasters. I mean, ultimately, the people that you just described, they clearly haven't done their research, because, I mean, how they believe they could buy a business with that kind of setup. It's just not going to work. If they spend any time researching the search fund model and they sort of read all the various different documents that universities like Stanford have put out there, what they're describing is quite different from the sort of model. Buying a business with no money down isn't really a realistic way to acquire any kind of quality business.
Yeah. So these people should not.
These people should not do a search.
Yeah, agreed. So, Will, a final question for you. What is your proudest moment working in this industry?
There's so many to mention. Every single deal completion is a proud moment, and it often means more working with searchers. A lot of the searchers we work with they are putting everything on the line, really. They're quite often they're leaving behind quite a lucrative career to put everything into their search. So every deal completion is a proud moment for me. But I think there's one moment which stands out for me personally, and that's being made partner on the 1st of April this year, which has been a goal for me from the outset, and I was mightily proud to have achieved that.
Yeah, well, me too. I'm very proud that you've made it, and to call you one of my partners as well.
Thank you very much.
But I do I do also completely agree with the getting a deal over the line is so much more satisfying when you've done it with these people that we work with, the searchers who we form really good relationships with, and we know that they are a great succession plan for great businesses. So completely agree with you there. Thank you very much for joining me on the first episode. As I say, I really enjoyed chatting to you about it. Not that we don't talk to each other about search funds every day of the week anyway, but don't forget to follow us on LinkedIn and Instagram. On Instagram, we are at Found and Funded Pod. And do please feel free to comment on our Instagram, on any LinkedIn posts you see, to tell us if there's anyone that you want to see on the podcast, or if you've got any questions that you want us to think about, or any topics that you want us to discuss. We'd love you to get in touch. Please do not hesitate to get in touch with me. Connect with me on LinkedIn. Thank you for listening. Thank you for watching, and we'll see you again next week.